All right, guys, thanks for joining us for our webinar. We are excited about this opportunity that we're about to share with you. And I just wanted to, present this to you along with my team. My team is here with me, Dugan, Omar, John, Jared would be joining us here soon. But yeah, we have an opportunity here to invest in an asset class that I believe has a lot of potential to build us wealth over the next couple of years. As many of you know, this asset class has experienced some tremendous headwinds, and there's been some turbulence in the market. And we've identified this opportunity, and we've been watching this asset class over the last couple of years, and we've identified this opportunity, and we have purchased several of these assets, and we just wanted to show them to you, show you what we're doing, and explain what it is that we're trying to accomplish here. And just wanted my team to walk us through that as well. And just looking forward to this. And Dugan, I will let you take a run at it here.
All right, wonderful. Yeah, so there is most of you that have invested in multifamily, or if you haven't been investing in multifamily, you maybe have been living under a rock for the last couple of years, knows that there's been massive volatility in the capital markets, right? So all loans, floating rate loans that were essentially sourced in the last few years have become under stress. I don't care. It doesn't matter what lender you use to essentially get your multifamily property a loan. It's in distress. So unless you're able to get yourself out of that distress and modify or restructure that loan, something's going to happen. It's going to have to be foreclosed on or modified or bought. And so there's significant opportunity. And what we're seeing is our ability to source off-market deals from existing clients of mine or people in the industry and be able to essentially structure these things as a soft assumption and be able to take advantage of the massive tax benefits as well as the cap compression, the equity that you're going to be able to reap when the Fed starts to cut rates and we start to see values increase, right? And so for those of you that don't know me, I'm the founding partner and managing partner of Kelly Clark. We're a boutique national law firm. We have offices in Dallas, Fort Worth, and Santa Barbara, California, but we service many operators, syndicators, and sponsors. I use those terms interchangeably, who are looking to essentially buy and acquire multifamily assets. So that's why this kind of is right up our alley, and we know exactly what it is because we're experts in this field. And on average, each and every year, we'll structure somewhere in the neighborhood of $2 to $5 billion in multifamily deals, just multifamily. That's not including other asset classes. So we really see across the country, you're talking from coast to coast, we see significant sample size of these types of opportunities. So we've got a full team that's on this. It's not just me. There's lots of people at Kelly Clark that are interested in making this opportunity very successful.
Thank you, Dugan. I'm Omar Khan. I'm the founder of Boardwalk Wealth. My background's in investment banking and private equity. My company, Boardwalk Wealth, has done over $650 million in transactions, both in the value add space as well as the development space. Happy to get into details. We've raised over, it says 125, but close to $150 million of equity across the board from high net worth accredited individuals like yourself, family offices, and quasi and institutional investors as well. So we're a fully stacked company. We do asset management. That is our specialty. We have boots on the ground across the Southeast and the Midwest. And as a result of that, when opportunities like this do appear, we are able to quickly capitalize on them. So to give you an idea, here's a quick snapshot of our company. We've done over 3,400 units, 650 million in transactions, average gross IRRs of 26.6, an equity multiple of 2x on past sales. So that'll give you an idea over here. And of course, Dave, we can share the PDF with the listeners as well, so that they can go through all the notes. They don't have to write anything down. And I have the pleasure of introducing Jared now. He's a great partner of ours. Jared, please take it away.
Sure. Thanks, Omar. So, Jared Fitzgerald, I serve as the Chief Investment Officer for Waymaker Advisors, as well as Kelly Clark, which is Dugan's firm. Also, John on this call works there as our CFO. My background, similar to Omar's, is in investment banking, primarily on the structure side and public markets. My part of this is on the structuring of the debt side and working with the lenders and the valuation models upon which the properties were acquired. So that's been my role. That's been my interaction with the properties to date.
Jared, would you like to tell us about why this opportunity is primarily driven by the interest rate volatility, as this is your specialty?
Yeah, sure, for sure. So in March of 2022, when the great Chairman Powell began his historic interest rate rise, where interest rates were increased 12 times during that period, that sort of led the stage or set the stage for the distress in the multifamily market. So if you're not really familiar with real estate, especially commercial real estate's valued on what are known as cap rates, and cap rates are tied to interest rates. As interest rates go up, cap rates go up, and that's actually bad for valuations. When interest rates go down, cap rates go down and valuations increase. So you can think about it this way: if the cost to acquire your property is lower, or the value upon which you are acquiring your property is lower than the interest you're going to pay to acquire the property, the deal isn't worth what you're buying it at. So what happened between 2022 and now is interest rates rose at a very rapid pace, the most historic ever, which led to the not fixed, the bridge debt in this space ballooning to astronomical levels, from 2, 3, 4% to 11, 12. The property simply couldn't sustain that pressure. What that allows is that creates opportunity. We now get to buy these properties, these distressed assets, which are only distressed because of the interest rates that are being charged. We get to buy these at the depressed valuations and be able to realize the gains as interest rates come down and valuations go back up.
Thank you, Jared. That's very helpful. And Jared's our resident in-house expert on capital markets and interest rates, so he's our go-to resource. Dugan, would you just like to briefly talk about how did we source these current and upcoming opportunities? Because that's a question we get all the time.
Yeah, absolutely. Thanks, Omar. Yeah, so it's very important for all of you to understand these are off-market opportunities. These are not through a traditional commercial broker. This is not a competitive kind of bidding process that goes through this. These are sourced directly from lenders, from multifamily owners, from CPAs, and other institutional investors. So these are people that bought at the peak of the market with a loan that is not suitable for the ability for that property to sustain that level of debt. And so now what we're able to do is see how we can acquire these properties at a substantially, what Jared said, is substantially reduced basis level, and be able to go full cycle and be able to exit at a very significant profit potential. All of these opportunities are in what we call the Sun Belt, and our partners, obviously, Omar, here's the day-to-day asset manager for this portfolio and future assets that are being acquired. He has an extensive presence, not just in the markets in which we're acquiring, but he has an extensive presence and experience in raw land development and going vertical with Class A assets, as well as value add in the Class C and B space. And so what that also allows us to do is control virtually everything from top down, meaning we're able to have relationships with the lender that helps us structure the debt. We have a team member who has extensive experience in his own over a $500 million portfolio that he asset manages with all of his team members who are actual employees of his. We have third-party property management on this that are best in class, and they also are tied into asset management and Omar's team. So all of that gives us significant insight and what I would say key differentiators between people that are buying and bidding for assets that are on market versus sourcing assets that are off market, and what the opportunity really looks like.
Wonderful. Thank you, Dugan. And look, guys, a lot of this, as you know, is a relationship business. I know everybody says that, but real estate still is a relationship business. You hear about big companies like Blackstone, KKRs, Apollos. Even companies at their size do not control even 1% of the real estate market. And why is that? Because relationships are key, and you can never have too many relationships. So this is why the key here, what Dugan mentioned, is these are off-market transactions sourced directly from lenders. This is why we are able to get an edge versus a typical person or syndicator who's going to come in, go through an investment sales broker, that there's going to be a beauty contest, they're going to bid up prices. We totally wanted to avoid that 100%. So just to give you an example, we've acquired this first portfolio here. It's a very attractive portfolio, 679 units across Florida, Georgia, Kansas, and Arkansas. The great thing over here is 6.9% cap rate, entry cap rate going in. The purchase price per unit is approximately $72,000. So very strong purchase price because it's very low. That's why it's strong for workforce housing. And most importantly, we have fixed interest rate at 7%. But what we've done with Jared and Dugan's help is that we not only fix the rate, we have an open prepayment, because as rates go down, we didn't want to take the risk of them going up. So we fix it at 7%, but open prepayment means that as rates go down, as the opportunities arise, we can either sell these assets and harvest profits or refinance without any prepayment penalties. Because one of the big pitfalls of having fixed rate loans is that if you ever want to refinance, you ever want to get out of the loan to strategically take advantage of changing market conditions, you can't do that. There's heavy penalties attached to it. The other big, very important component over here is the one-to-one depreciation to investment ratio. And Dave, would you like to talk about it? Or I'm more than happy to talk about it, because this, to me, is one of the most attractive features of this portfolio.
Yeah, so as many of our multifamily investors know, or many of our investors know and appreciate depreciation and how it works. This is unique in that our basis is so low going into the deal, and with a combination of low cost basis and cost segregation studies, and using using current bonus depreciation, you can be at 100% bonus depreciation or 100% depreciation in year one. So really meaning if you invest $100,000, we're projecting that you'll get $100,000 in losses or more in year one.
Yep. Look, guys, that's it. That, to me, when we did the math, we ran the numbers, we've done this a lot. That was very alluring and attractive to me, because, I don't know about you guys, I hate giving more of my money to Uncle Sam. And I hope that's the sentiment more people on this call resonate with. Also, a couple of big pointers I'd like to add, because I like to see this for myself. We are getting a 16.4% discount to the last purchase price and a whooping 35.8% discount to recent appraisal. Now, this appraisal isn't years ago. This appraisal is anywhere, depending on the asset, between April and July of this year. So compared to appraisal, we're getting over a third of the value off. So that just tells you how much juice there is. There's also organic and forced rent appreciation that we can do. We're going to get into it, $75 to $200, depending on the unit type, depending on the property. But now let's get into returns. So I'm going to show you 3 and 5-year projected returns over here. Here's the kicker. Obviously, the way the IRR calculation works, if you sell earlier, all things being equal, your IRR is higher, but your equity multiple, which is total dollars, that's going to be slightly lower. If you sell later, all things being equal, your IRR is slightly lower, but your total dollars equity multiple is higher. That's the context I want to provide you, because as you can see over here, depending on which class of investment you come into, whether you're class A, B, or C, it's all dependent by how much money you're looking to invest. You can get up between 90 to 20% IRR on 3-year numbers. Look over here, please. Or 15 to 16% if over a 5-year period. 1.6 all the way to 2x equity multiple. In just nominal terms, think about it this way. You're targeting, depending on where, how much money you're investing, anywhere from 18 to about 24% on a 5-year basis. Now, that is very attractive, especially considering the fact that it's a 1-to-1 investment to depreciation ratio, and for investors to potentially have the ability to now 1031 their funds at a future date into future project. Lots of my investors do this. In fact, on pretty much all the recent projects we've done, developments or acquisitions, we've had 1031s because, again, real estate is one of those preferred sacred investment classes with so many tax write-offs. And that's why we love it. Dave loves it. Everybody on this call loves it. So a couple of pictures over here to give you an idea of how do we run our properties? What do we do? Because our focus is on providing quality communities with amenities that actually matter to residents. And we've actually, this is not a hokey pokey pie in the sky sort of, we've all got to hold hands and sing kumbaya sort of deal. This is real. We've actually done the analysis on this. When you actually create safe and affordable communities, your retention ratio goes up. Retention ratio is how many people choose to renew their lease. Now, the underappreciated aspect of this business is that anytime a resident leaves, which means if you have to look at it in cold business terms, anytime a customer leaves, it's not like you're just getting potentially more rent. There are lots of costs associated with it. So you have to do repairs and maintenance. You've got to do turnover. You have to advertise. Your administrative costs go up. Then your payroll costs will go up because your maintenance people are doing more work. There's a lot of things associated with this. And we did the math that, unlike the typical syndicator that will always talk about how much rents are going up, we did the math to see, okay, well, what is the impact on the bottom line? Because yeah, my rates can go up, maybe, but there's costs associated with my rates going up. And we did the math and realized very, very, very early on that unless your rates are not going up by $100, $150 minimum per month, oftentimes it is better because you take your expenses into account to actually do a better job, have a safe, stable community. And these are just common sense things that a lot of people, for whatever reason in this industry, don't seem to think about. It is better to have a safe, stable community so your retention ratio goes up, so all these other expenses are taken off your plate. Because look, either you can fight to get new customers, new residents in this case, to possibly get more revenue, or you can keep your existing customers and residents happy. They don't leave, expenses stay lower, all of those savings go to the bottom line. So what else are we envisioning doing on this portfolio that we've acquired? And by the way, this is first of many portfolios. So our team has done an extensive deep dive. They're on site. They've done their due diligence. Our plan on the interiors is paint, appliances as needed, because some of the appliances are good. And oftentimes what we do is we cycle appliances between various apartments as well to ensure that we don't spend a lot of money there. Typical vinyl floors, resurfaced countertops, fixtures, bathrooms, including low flow toilets. That is really big because it helps you to save on utility costs. That's a big line item savings you can do, and a lighting package. And this, depending on the unit, depending on the property, is anywhere between $5,000 to $12,000, $13,000 a unit, where these things end up. And again, you also have to realize a lot of times we don't go in and do the full scope of things. So as an example, we might just upgrade vinyl floors on one unit because we're strategically doing this. We're strategically managing capital, because what we want to understand is you never want to over improve the property because the market can only bear a certain rent. So over improving it, making it look like the Taj Mahal actually is a bad financial decision. You want to do just the absolute right amount and not a dollar more. On the exteriors, paint, asphalt, parking lot, landscaping. This is one of my favorite things because, again, everybody thinks that this is a hokey, who cares about landscaping? But I can tell you, curb appeal is so important because as soon as somebody drives in to your community and they feel pleasant, they feel nice, things are clean, landscaping is done, paint work is done, woodwork is done, the trash enclosures, excuse the pun, are not trashy, the HVACs, all of these things are done, they already feel nice about the community. A lot of this becomes psychological. Like before they even talk to the property manager, they'll probably go around the property. If everything is clean, nice, safe, quiet, they already start envisioning themselves in the community. That helps the sales process more than you could put the world's greatest salesperson as your property manager, but the outside looks like a war zone, right? Think about what are the items you would like in a community. That's typically what every other human being likes. Now, we can go into some of the details here as well. We're very data-driven here. This is for the entire first portfolio. This shows you various unit layouts over, hold on, let me go over here. This shows us the various unit layouts. It shows the number of units, the square footage, the in-place rents, but what it also most importantly shows is what is the rent premium and what is the opportunity we have right now with today's rents. What is the opportunity? And the last two columns over here, you can see, show you at 6.5 and 6% cap rate, what is just the upside here? Because the last people, they went into this, a lot of these syndicators and owners right now are in this, what we call a doom spiral. What starts happening is people have reserves. Interest rates shoot up. Now the reserves they were going to use to potentially renovate and upgrade their community, a lot of those reserves now are used to pay debt service costs. When those reserves are used to pay debt service costs just to keep afloat, well, guess what happens? You don't upgrade and renovate your community. When you don't upgrade and renovate your community, you don't get as much rent as you should be getting. When you don't get as much rent as you should be getting, your profits go down. What does that mean? This means you dip into your reserves again, and soon before you know it, these reserves are completely depleted. So this is why, excuse me, we've seen a lot of guys get into a doom spiral, and that's not very helpful. But this allows us the ability to capitalize on this great opportunity we have. So Dave, do you want to talk about some of these multiple exit opportunities? I can discuss this as well, but you've been the recipient of some of the great things here. So I think you can speak from personal experience.
Yeah, so a couple of ways, a couple opportunities we see here is, if we were to hold the property, there's definitely the opportunity to refinance. As Omar mentioned, we're in a fixed 7% interest rate range. So, we are locked in. We it's not going to go up any higher. We got another, 2.5 years left on that fixed 7% interest rate. So we have some security built in there. But right now, agency loans from Fannie Mae or Freddie Mac, you can lock in these interest rates right now for, somewhere in the low fives from 5.
In fact, I'm doing one right now, Dave, in Atlanta, and my rate right now is between 5.05 and 5.15.
Yep.
And I haven't locked it because I know in the next 2-3 weeks, rates are going down even more, or at least that's what the forward curve is showing.
Yeah. So, as you can imagine, if these properties work, and they do, the positive cash flow at 7% fixed, what would they look like at, 5.1, 5.2% interest locked in for an extended period of time? So that's one of the plays. The other one, that we're also interested in is, what does this look like on a 2 to 3 year exit? If interest rates continue to come down, or if they drop them a couple, a basis point or more, what does this look like in 2 to 3 years from now? So the opportunity to sell in 2 to 4 years, and or the opportunity to just lock in long-term fixed rate interest rates at 5.1 to 5.3% and potentially lower by the end of the year.
Yeah, look, Dave, you hit it right on the head. So the reason why I'm so personally excited about this, and my team will tell you I never get excited about these types of things now, is because of this great opportunity Dugan and Jared have been able to source. They have proprietary relationships with lenders. A lot of those relationships I have gone full cycle with on. Like, we've done deal, sold them, refinanced them. They know me as well. And that relationship, as I mentioned at the start of this presentation, this is all a relationship-driven business. You'd be surprised at how many billions of dollars of transactions get done because two parties feel comfortable working with each other, even though the price there might be slightly lower. Those relationships you can't buy. You can't just show up with a bag of cash and buy those relationships. And because of our relationships, because we did the right things in the lead up to this crisis of sorts, that's why we're in a position to capitalize on this, whereas a lot of other people are playing defense right now. And I can tell you, there's a short window of opportunity when rates start materially going down, say middle of next year-ish, first quarter end, middle of next year, this opportunity goes away because not everybody will want to get back in. And usually when everybody's getting back in, that's the time you want to be selling your assets, because now you bought something at a discount, you want to sell it back to them. So look, how about we leave it for Q&A, and let's answer some questions people have.
Yeah, so feel free to drop some questions in the Q&A. I have a couple here that came in prior. One of them is, what are some of the risks associated with this investment? How is my investment protected? What are some of the downside risks that we would say, okay, well, there's risk to any investment. What could this one be? What are the top 1 or 2 risks that you're seeing, Omar?
Well, look, first of all, there is always going to be a risk. Anybody who tells you that you are going to potentially get mid-teens or higher 20% IRRs without any risk, they're lying to you. We know that. The typical risks are always, is there a major, we're talking like a 2008-esque recession on the horizon, number one. And number two, are the metros we have chosen, is the growth story they're going to stop? So think about it this way. Is Augusta, Jacksonville, Kansas City, Little Rock, are people going to stop moving there and say maybe start moving back to California and New York? Now, the last 30 years of data, our experience in these markets suggests otherwise, but that is a potential risk because the tide can always turn. The other risk that we feel is that what if the Fed does not cut interest rates? Now, that was a risk that I vocalized at the start. This was like a few months ago. And what we have effectively seen, even since July, if you see the 5-year curve, in fact, let me open it up because I want to show you where the 5-year rate has been. And that can give some idea. And by the way, this is all publicly available data. So I'm going to show it to you and y'all can go look it up yourself as well. These are all pieces of information you do not have to rely on somebody for. So can you guys see my screen?
Yes.
Yeah. So this is, you can, in fact, here you go. How you access this is type US5Y, which is United States 5-year. That's basically the 5-year treasury. You can type US10Y. That's a 10-year treasury. I've opened these up. Here's the deal. So if we look at the last 3 months, you can see how much the rates have declined. And this is before, by the way, the Fed has announced an official rate cut. Now, there's speculation this week, I believe, when they meet, next week when they meet, they might announce a rate cut. But the market has effectively priced in a rate cut because if you look at the peak 3 months ago, on 1st of July, the rate, the 5-year closed at 4.396%. Right now, it is 3.424% right now, as of whenever this is updating. So this is already close to 1% down, something like 20% down, 25% down already over the last 3 months. And it is projected to go down even more. So there was that, initially, when we were getting into it, that was my biggest concern, that what if rates stay up longer for a longer period of time? What if it's not, they're not going to go down this year, they stay on till next year or maybe the year forward. But the data, the pricing that's coming in is effectively showing us that rates are not only going down, they're continuing to go down. The other big item that I feel is an opportunity over here is the fact that the doom loop or this death spiral thing that I mentioned, there is so much meat on the bone in this portfolio because frankly, the last owners, A, ran out of liquidity and B, were ill-equipped. A lot of these are private mentorship group type people. There is no employee, everybody's a leader, nobody's a follower. And when you don't have professionals at each level of your company that do this full time and have been doing this for a long time, they're just going to leave a lot of money on the table. To give you a very simple example, in the last 2 weeks, we've already signed cable contracts with Xfinity and Spectrum that, depending on the property, are bringing in anywhere from $15,000 to $30,000 as a one-time fee and about $35 net of costs revenue once people sign up. This is all low-hanging fruit that should have been done. I mean, I can tell you this, I didn't invent the concept of signing a contract with Spectrum or Xfinity. But this is all things that are done. This is all part of our checklist, and these people hadn't even done that. So that's where the real big opportunities, low-hanging fruits. We don't even have to go into esoteric subjects, basically.
Got another question here. What are some
Just real quick, what I would add, Dave, because I think you've voiced this before when we talked about risk before, and speaking for Jared and Dugan that seemed to have dropped off, is that executional and operational risk was something at the very beginning when this opportunity presented itself through some deep relationships. And that is where Boardwalk Wealth really came in. Having that vast experience, both from being able to asset manage, have deep relationship with property managers, and having that experience was extremely critical in making certain that we mitigated that risk top of line.
Yep, thanks, John. Got a question here. What are some typical operational improvements Boardwalk puts in place to improve NOI?
Oh, we literally have a slide for this. I can show you this. Hold on. Maybe I glossed over that. My apologies for it. This is not only what we are planning or doing. This is about 80% of the value add in the workforce housing space. You can see my screen, correct? The value add opportunity slide. As a lot of in the segment that we're playing in workforce housing, a lot of what we do is to figure out what is the maximum possible rent the market will bear. And oftentimes we're either at it or slightly below it to ensure that our occupancy is maximized. But we keep a very sharp eye on what improvements are there. Now, I can tell you this, in the last few years, I've heard a lot of people tell me, hey, why don't you put a smart technology package? And why don't you put like all these lockers things that you have to pay $40,000 a locker for and this and that? Guys, I can tell you, that's nice to have. Your residents aren't going to pay you money for that. We are laser focused on things where residents are going to pay money. Henry Ford is reported to have said that if I asked my customers what they needed, they would have told me to build faster horses. You know, if you ask people, like, what do they need? Everybody, of course, I will tell you the same thing. I need a private jet, I need a Rolls Royce, and I need a $40 million mansion. But the question is, what amenity and service do you need that you're going to pay this market rent for? And that is the question that is answered by these sets of improvements that we're doing on the properties and nothing more.
All right. I got one more here. I know we mentioned it briefly, but talk about the hold time and what you see could happen and what could affect the range of that hold time. You know, depending on if we decide to put long-term fixed rate debt on it, if we decide to hold for 2 to 4 years and turn around and flip the property or the portfolio, and talk also, we didn't talk about the REIT model and how we didn't talk much about that and how this is sort of put together as a REIT and not as individual properties.
How about I start from there, because I think that is one of the most important questions. So guys, think about, you have to realize John Bogle, he's by the way from Pennsylvania, he died, he's the founder of Vanguard. He said the only free lunch in investing is diversification. That's it. Otherwise, no free lunches exist. So when you're typically investing in a transaction, if it's a single asset transaction, look, whether it's real estate, whether it's any other vertical, whether you're in tech, you're in financial services, if you are investing in one thing, the biggest risk you can take, especially in real estate, is that your fortunes are tied to the performance of that one asset. And that is, by the way, something that has led to us having access to this opportunity, because a lot of syndicators, a lot of owners were buying one asset at a time. They were not diversifying their investor risk across multiple assets. The whole reason why we are buying portfolios is because what happens is when we go to a lender, the lender isn't going to just give us all of their stars and not give us any of their dogs, because then they're not really solving any problems for themselves. And you know, no lender is that nice. So when we go to a lender, we say, Mr. Lender, what's your problem? And first of all, they'll say they have no problems, because obviously they're the ones, angel, that has no problem, but everybody has problems. And they'll give us, eventually, when you talked enough times and you have a good relationship, they'll talk to you about their dog. So out of 5 assets that we've acquired in the first portfolio, One asset was a dog. Dog is just a bad performing asset. But to make up for that asset, we acquired 4 stars. Stars are overperforming assets. So overall, portfolio-wide, there is positive cash flow. And by the way, investors are invested in the portfolio. So one asset's performance does not imperil their future. In fact, the portfolio, collective portfolio's performance, by the way, these portfolio has assets in multiple markets as well to offer you further diversification. That's the key factor that really pushes the needle. What were the first 2 questions that you asked over there, Dave? Sorry, I get very passionate about this, guys. I do this for a living. I love what I do. This gets me really, I mean, we can talk for the rest of the day about this stuff. Yeah.
Hold period, and what could affect whether we hold for 2 to 4 years? How do you see the, we're talking about potentially fixing long-term fixed rate debt on the property, or possibly flipping in, 2 to 3 years, 2 to 4 years. Talk about the hold time for this asset class.
So the underwritten hold time is 5 years. You saw those returns. But as fiduciaries, we always have to act in investors' best interest. So for instance, we are doing this transaction now, literally tomorrow, not a euphemism, literally tomorrow, somebody can come in, and if they give us a price that is better than market and say better than our 5-year target, we will sell this property. So our underwritten hold period is 5 years, but the way Dugan and Jared have skillfully negotiated and structured this transaction, and we work together on this, is to ensure that we have open prepayment. There is no prepayment penalty. This allows us the flexibility of running things business as usual and really capitalizing on all this forced appreciation. Excuse me. Having the ability, but not the obligation to refinance. And by the time, if we get to the 2.5 year cycle, if rates go down more and we feel there is still more juice to be had as opposed to just selling, then we have the ability to refinance, cash out refinance, typically return a good portion of investors' capital back to them. By the way, you don't get taxed on that. The refinance dollars that you get back, you don't get taxed on that cash. So cash hits your bank account, you don't get taxed. And then run it long term. The reason why you need to have this flexibility built into your system is because it's the same as buying one asset versus spreading your eggs over multiple baskets. Why you need to have multiple exit opportunities and thought processes is because none of us knows what the future is going to be. So because we don't know what the future is going to be, we always want to put ourselves in an advantageous position that regardless of what market events occur, we are not imperiling the investment that is entrusted to us. And as fiduciaries, we can take the best steps under all market conditions.
All right. So that is it for the questions.
Hey, would you like to talk about the, just once again, about the one-to-one depreciation as well? Because I know that's very important for people.
Yeah. So again, because of our low cost basis of, less than 10%, around 10% of the asset purchase price. And because of, cost segregation study, combined with, even today's bonus depreciation, those are all the reasons why we can go with, why we're projecting 100% bonus or 100% depreciation on your invested capital. So again, meaning you invest, let's say you invest $100,000 or $1 million or whatever the number is, it's dollar for dollar on the depreciation. That's a projection. We believe that it will be more than that, but that's what we're projecting for year 1. So this is a very favorable, I don't know of any more favorable tax preferred investments than this one right here. And again, we don't lead with that normally. This is an investment that we believe we can make a lot of money on when we turn around and sell in a few years. It's a cap rate compression play. It's also, slight value add or a value add play, but we believe there's some serious upside here. And we also, know that we're going to get a lot of depreciation here that works very well for investors.
Wonderful.
So
Yeah.
I don't believe I have anything else. If you guys have, John, Omar, do you have any parting comments before we close this down?
Nothing from my side, John. Do you have any comments?
No, I think I would just reiterate what you had said at the top. I mean, this is somewhat of a very unique position and a unique opportunity that, at least in my lifetime, only presents itself, due to seasonality and different perfect storms that come together. That's presented itself maybe every 20 years, 30 years. So anyway, I would just kind of reiterate that fact. It took a culmination of different events. And I think that we're in a really, really, really good position to take advantage of the opportunity.
All right, so we will send out the recording along with the investment summary. So if anyone has interest and wants to join us in this opportunity, you can reach out to my team or respond to the email that you'll be getting along with this recording. So we look forward to it. We look forward to having conversation with you guys, and yeah, we're excited about this opportunity, and we look forward to doing it with you guys.
Thank you, everyone.
Thanks, guys.
Thanks.
For now.